Okay, ladies and gentlemen, I'm very happy to have Joe Constable back with us from H&G High Conviction Ltd. It's a new IPO in the listed investment company space, going to be focused on micro and small caps. Joe, it's been a fund that's been around for a while, and we've had you on before talking about the unlisted fund. Maybe just give us a bit of background on the transition now from the unlisted fund to the IPO, and then details on the IPO itself.
Yeah, Mark, thanks very much for having me back. It's good to be here. And yeah, a bit of history. So the fund has been going for 14 years, and it was the H&G High Conviction Fund up until June. And we had about 12 unit holders who've been there the whole time. And we converted from a unit trust into a company, and that became the H&G High Conviction Ltd. And we had perennial value management invest for 18% of that, and with the vision on an IPO. So that's what we're in the process of right now. We're currently in an IPO, and we close this Friday, and we will be quoting shares on the 25th of October. So we're in a pretty exciting time. The fund itself is about $18 million at the moment. We're looking to raise 10 to 20 million. So we'll keep it nice and nimble. That really suits our style. We're investing in microcap companies, so we like to be able to play in that space, which is generally uncrowded, and that's what we've always been in and what we love doing. And the actual, for the IPO, the lead manager is Morgan's. And if anyone is interested, it's definitely worth going to our website, highconviction.com.au. And there you can read the prospectus, the target market determination, and if you think it is something that suits your investing interests, you can speak to your own stockbroker, and they can put bids straight into Morgan's.
Okay, perfect. And then has the ASX allocated you a ticker code for the company yet?
Yeah, it will be HCF.
Okay. So yeah, for people should watch out for that then on the 24th. You said 24th of this month. It's going to be going live on the board.
Yeah, that is 25th of October. Yeah,
25th of October. Okay.
On the board. So yeah.
Okay. So
an exciting time for us and for Hancock and Gore, which is the head company that is the manager of this. It's the first flagship fund management product going out.
Okay, excellent, exciting. Yeah, we haven't had there's not too many licks in the microcap space compared to the I guess managed fund arena. So it'll be good to have another one in there, along with people will be familiar with probably Wilson's Microcap and Saltaire emerging companies. So yeah, there's not many there to choose from if you're looking for in the listed company space. So good to have another one in there. And let's, I think, drill down into two of the stocks that are going to be in the new listed investment company. The first one is Valley Energy, and we were talking just before we started a stock I think I know you've held for many years because I've followed the fund in its various iterations. Kind of a story of right place, right time, I think it'd be fair to say with Po Valley. But for people who mightn't be familiar with it, just give us a background on kind of what they do and how they make their money.
Yeah, we'll do, Mark. Yeah, so as you said, Po Valley has been a very long-term holding for us. And for full disclosure, I'm a director of the company and also own shares personally. But so PVE, the ticker, it owns natural gas fields in northern Italy. And it's, for us, as I say, we've been in there for about more than 10 years. We participated in a big recapitalization in late 2015. But the thesis really has been that it holds strategic assets. And that's because Italy imports about 90% of its natural gas. And in turn, natural gas accounts for the majority of the country's energy production. So that's really why we think these are important, really important assets. And of course, even before the tensions with Russia and the Ukraine war began, they were important, but they've become even more important over the last 6 to 12 months as natural gas prices have skyrocketed and Europe is just scrambling to find its own source of gas. And Russia itself used to account for about 40% of Italy's gas consumption. But in terms of how it makes its money and where the near-term inflection point is, Po Valley has two main assets, two main gas fields, and it's one of the ones which is onshore called Selva, and that's near Bologna. That's what's really about to be a transformational time for the company to bring it into production. And this is a well that was drilled in late 2017 and was very successful early 2018 when the results came through. And it's taken a bit of time, obviously. We now fast forward about over 4 years, and that's just been a bit of a hold up in the Italian bureaucracy. And I think mainly because they didn't have these sky high prices breathing down their necks. So everything's happened pretty quickly over the last 6 to 12 months, getting the final production concession, which came in July. So the company's ready to start producing from that in the first half of next year. And a recent broker report that the company had done by Peloton Capital stated that the company should be producing something like $22 million in EBITDA in the first year of production. And that's with gas prices about half of what the futures are at the moment. So $22 million of EBITDA, the company's current market cap is about 66 million. So we're talking 3 times EBITDA. So it's a pretty fantastic value proposition. And as you said, right place, right time to be contributing this natural gas and helping at a time of an energy crisis in Europe. So that's really the short-term focus for the company. Get to first gas early next year and start cash flow production and generation for the company.
And in terms of the second asset or their second field, where is that in the continuum of exploration through to actually producing gas? Is it kind of further back in its development, or where would that sit?
Yeah, not in terms of actual exploration. So the fantastic thing about Po Valley's assets, and both of them the same, Selva and Tito, they were both owned by Eni, the oil and gas, the natural gas giant of Italy, which used to be government owned. And in the 90s, the EU brought through energy regulation, and Eni was forced to relinquish a lot of its domestic gas fields. So this is how Po Valley got them back in the early 2000s. And so because of that, Eni had actually done all the exploration, done the drilling. They actually produced from the onshore field, and they did very successful drilling on the offshore field as well. So they're de-risked from that point of view. They have 2P, that's proven and probable reserves that have been independently verified. So there's no exploration risk, which is fantastic. And so Selva, as we said, has got all the production concessions together. Tito it's a much bigger project because it's offshore, unlike Selva, which is very cheap to the onshore one to get into production. Selva requires quite a lot of capex, probably in the order of 60 million euros. So it's never really been one that Po Valley would develop by itself. So it's got the reserves there. What we need now, we've had the environmental approval given about a year and a half ago now, and the key next step for that field, and as I said, it's a really big gas field, is either getting a JV partner in or selling it. Those are the two options, or some sort of asset realization program in that. And so that's the exciting thing. But for that, it's been a bit more tricky because of regulation in Italy over the last few years. It's been a bit unclear on whether that can be produced from or not. And that's just in terms of it's about 12 and a bit miles off the shore of Ravenna, near Venice in the Adriatic Sea. And historically, it was given the environmental approval, but when the government redrew where can and can't be produced from, it left it a bit unclear as to whether that can be produced from. So that's the key for the company over the next few months, is to get some clarification on that. And to that end, there's a new government that came in with the elections just over a week ago in Italy. And the comments of that new government that's come in, or the Prime Minister Meloni, is quite sympathetic, or at least sees the need to increase domestic gas production, and is even quoted the Adriatic is an important place to get that. So that's the focus of PVE, the offshore asset, is to get some sort of certainty from the government and then work out the best way to realize the asset. And just to put it in context, the two assets together, independently valued, came in at about $132 million. And again, that's compared to the market cap at the moment of 66. So there's really decent upside, and there's more that can even come from further drilling. So that's the thesis there.
And we flip the coin around. You know, for every bull case, there's a bear case. You know, what is I guess some of the risk from these? Is it, you know, unforeseen delays in commissioning of the onshore field? You know, it doesn't happen start of next year, it gets pushed out to the end of next year. Is it you know, natural gas prices coming down because supplies are secured elsewhere, you know, in the interim, and you know that brings down the whole, you know, DCF on it, or some resolution to the Ukraine-Russia thing, and you know they're happy to take gas back from Russia. You know, are those kind of some of the main ones that kind of keep you awake at night, or is there anything else we should be thinking about?
Yeah, all very valid. You've really hit the nail on the head on all of them. To take them one at a time, as you said, Italy has historically been quite slow to work the way through the bureaucracy. And you know, the good thing is that it all is above water and by the books, but it can take time. So there's always that risk. As I mentioned, we very thankfully received the full production concession, and that was announced to the market in July. So that was really the key milestone, and that was what we were worried about. That could just be delayed for a long time. So that significantly de-risked that Selva onshore project. So we would be hopeful that we should be getting that online in the first half of next year. But again, who knows? And there's always execution risk. We need to get a gas plant and pipeline built. It's a 1 kilometer connection to the grid. So again, execution risk there. There's also, as you mentioned, gas prices have been a key factor. I mean, they've gone up by talking about eight or so times. So the interesting thing for us is that we've always done our valuations at historic average price, which is to say it's about 8 times less. The independent valuer that put them at combined 132 million Australian dollars used about half the gas price futures as they are today. So there's a lot of wiggle room. You know, we're talking about if prices remain as they are now, there's serious upside on the current valuation. But you know, even if they were to halve, there's still decent upside. So you know, we think that there's still a way to go, and I think the importance of securing domestic security and domestic supply of energy is still going to be there. And it's hard to imagine that you know, if there is a resolution in the war, Europe is suddenly just going to start buying like crazy from Russia again. But you know, that there is that risk there. So you know, high commodity prices don't last forever. But our thesis isn't based on these crazily high prices, but we believe that a high price environment is probably there for the future, considering what's always been the issue, the underinvestment in natural gas as a transition fuel.
Okay. And then things in terms of Po Valley, things we should be watching out over the next 6 or 12 months. So there's commissioning, flow of gas from the onshore facility, the pipeline getting built, and the offshore one. What should we be looking out for there? Is it you know, kind of clarification on you know, the ability to produce, or is there more technical studies that are going to come out to, you know, further prove up reserves, or to kind of button down the, you know, the total cost for a JV partner coming on board?
Yeah, so the first thing is in terms of the onshore field. So expect a fair amount of news flow, and that's just all to do with getting the pipeline constructed and getting everything ready for first gas, and that should, you know, come bit by bit over the next 6 months or so. and then finally being connected to the grid. So there should be a decent amount of news flow in that towards first production. And then also along those lines, there's a lot of upside in the onshore resource. So as I said, we have these 2P reserves, and that's based on what was drilled in 2017/18. And we can also drill and get everything ready for drilling once cash flow comes in early next year. So we'll start doing the studies and getting everything prepared to be able to actually start exploring, and we'd look to double or treble what we can produce from that. So that's upside on those stated figures that I've given you already. And that's news flow for the onshore. For the offshore, it's about, as I say, de-risking and getting some clarification. So the government should be formed by the end of this month, and that will be the important first step. We really will have to wait for that. And then it's about getting some clarification on what the actual policy is and how they're going to address what they've already stated about shoring up domestic supply. So I think once that comes through, we'll be able to give a bit more indication. And yeah, as I said, there are multiple paths from there, whether it's a JV partner or realization or really, but the first step is getting some clarification on policy.
So we'll wait for the new minister to be installed and this government's policy to be formalized and see what flows out of it. If we move on to the second stock, one probably a bit more known to people, been around for many a year, Centrepoint Alliance. But for people who mightn't know Centrepoint Alliance, just give us a bit of a background on how they make their money.
Yeah, so Centrepoint Alliance provides services to financial advisors, and it also has a group of salaried financial advisors. And so the services, which is the rump of its business, that it provides to advisors are licensing and compliance, and also technology. But it also has a mortgage lending and also funds management solutions business. So the group itself has about 500 or more advisors on its license, and it also has 192 self-licensed firms, all of which use Centrepoint services. So it's built up a very significant advice business over the last 15 or so years.
And I mean, there's no shortage of these kind of businesses around. We've had Diverger, Sequoia, InvestSmart to a kind of lesser extent, AMP if you want to throw them in there as an option. But given there's a few options in this sector, what was the thesis to pick Centrepoint Alliance over some of these other options?
Yeah, so we think it's really well placed as a industry consolidator. I think it's that's why we're excited. We think it's got a really clean balance sheet, and it's also got fantastic reputation in terms of its advisors. So those are what attracted us. In terms of a little history of how we came to know it and where everything's going, and part of our thesis really, it was subject to that crazy turbulence that took over this whole space, the financial planning industry, and that was following the Royal Commission into Financial Services back in 2018. And in terms of Centrepoint, and again, another reason why we really like this one and chose it is that institutions just sold out of the company, and it became increasingly well valued from our perspective. And it was pretty much a price as if it was going out of business. But yeah, behind that was what we thought was a superior business that had fantastic advisors and very happy clients, but there was a lot of uncertainty. And I think often the market can be in the worst place, and you get the best bargains when there's uncertainty. So that's really what attracted us to it. And that was in about October 2019, and it was trading around 11 cents per share. And again, as I say, we thought that was great value, especially because Centrepoint was in this fantastic position to actually benefit from all that dislocation in the advice business, and essentially because it's independent and unlike say an AMP or some of the bigger banks, could attract advisors in, because it wasn't a vertically integrated business in the same way.
And
yeah,
I mean, we've seen the new, speaking of the Royal Commission, let's talk about risks for a second. We've seen the new treasurer talk about, you know, financial reforms and, you know, having a complete relook at the cost of advice and the, you know, the compliance around advice that, you know, has, you know, increased dramatically for advisors and, you know, people who service advisors, and the exit of advisors, you know, from the industry because of you know, these enhanced compliance regime that we've seen develop. You know, it was building before the Royal Commission, and then the Royal Commission, I think, took it to another level. So where, in terms of risks, you know, is this, you know, another sea change potentially going to happen in terms of regulation? Is that a major risk to them, or is it more that's going to be the environment and they will adapt as they did post Royal Commission, and like any good business will, you know, find the opportunities in the new environment? Or you know, is the risk, as always with advisors, and it has been in Centrepoint Alliance past, going, you know, way back in 2014, 2015, where, you know, they had a large bout of you know, civil claims that, you know, led to a huge fine that had to be, you know, paid off, which it was over many years. But that's, you know, a universal risk, I think, across all businesses in this space. It's not one specific to Centrepoint Alliance, but it is a risk that's there. But, you know, risks for you, is it more the potential regulatory change and what that does to the business model, or is it, you know, something else?
Yeah, so we think in terms of risks that, yeah, regulatory is always potential, and I think so. What we're getting is the quality of advice review that should be prepared by the end of this year by Michelle Levy in the Treasury Department. We see that as having a higher potential for removing a lot of the uncertainty in the industry, and you know, there will be changes, and potentially, and Centrepoint will have to adapt, but they're in a very good position by being the group that's actually providing the services to the advisors. And we think that will only be more important going forward. And we hope that following that review, as I say, there should be some certainty, and the kind of flux of the whole business and the whole industry should actually die down a bit. But we've been very impressed historically with Centrepoint's ability to be able to pivot. And as you say, they were on bad books, and that was again where the opportunity came for us with previous management and what so many people in the industry were doing in terms of product rebates, and they had to pay back a lot of in fines and change their business model. But they were amazingly successful in doing that, and that was going from making most of their money from product rebates to actually fixed fees, and that's what makes it, to us, a very attractive business, is that they are charging on average, say, $35,000 to their per advisor for the fees that they give them. So it's, again, very sticky and long-term revenue. And we think that on the whole, there'll be more advisors continuing to go independent and not want to be part of a big institution, maybe set up their own practice, and then Centrepoint will benefit. And again, they were the only group to actually, in the top 10, to actually grow their advisors over the last year. So we thought that's a pretty good sign of how they can fit into this industry.
Yeah. And then things we should be watching out for over the next 6 to 12 months. The Treasury review will be applicable to all players, so we're going to watch that and just see what comes out of that. But specific things you're looking from Centrepoint, another AGM will be coming up, whether they'll give us a bit of an update on how the year has started there, and then we'll get first half results in February next year. Yeah,
well, I think that's the main things we'll be looking out for, is an update of the AGM, and then the results coming out early next year. And it's the other thing and why we're really excited is that they are in a position to be pursuing this industry consolidation. So they actually received a takeover bid from listed competitor that you mentioned, Diverger, and that was earlier this year, around June or so. And that was half cash, half scrip at 32.5 cent price. That's a decent premium to the current share price. But Centrepoint rejected that because it undervalued the company. And I think they are actually in the right place and position to be acquisitive. And I think that they've stated that that's their intention. So we'll see what they can do, but that's definitely something to watch out for. The management team, the current management team, did a really commendable job when they acquired Clearview's financial advice business. That was about a year ago. And they've been able to have some fantastic synergies and really grow their earnings in a very accretive way since doing that. So we back them to do a similar thing. And I think it's better off them doing it than being acquired. But a risk is still that because there's consolidation around it, they get acquired and some of the upside gets left off the table. But in terms of, I don't think I really fleshed out our thesis and why we're excited even about it now, and what's the great base that you can buy in at is that their revenue is something like, or their net revenue, you're talking around $33 million, and that's pretty, as I say, pretty steady considering the revenue sources and the kind of fixed fees you're getting from advisors. And then they have costs of about 25 million, so you're getting something like $8 million in EBITDA. And they don't have to really do much for capex or leases. They have large tax losses, so the free cash flow you're really getting is about $7 million. That's a yield of about 13% free cash flow. They pay out really decent dividends, historically have fully franked, and it's about 6% dividend yield in the last 12 months, and that doesn't account for a full year of Clearview coming into the business. So from a valuation base, I think it's a decent time now, 5 times or so EBITDA, with this potential to be the acquirer and to expand. So those are the catalysts that we think can unlock value over the next 6 to 12 months.
Yeah, you mentioned Diverger there. I saw they did an acquisition of some SMSF administration business today or yesterday. I can't remember when it was. And you talk about Clearview, used to be listed. That got taken out by Centrepoint. We've seen Class, the other big SMSF one, get taken out a while back. So it's definitely there's a lot of moving and shaking happening in this arena. So as a sector as a whole, it's a pretty interesting sector in terms of who's doing what and who's trying to get market share and who's going to be the new leaders in this space. And the wonderful thing about a lot of these financial services businesses is as you talk about the Clearview thing coming in, there's generally great synergies and real benefits from having more scale in a lot of these businesses.
Yeah, fully agreed, and I think that's the idea, and build up a strategically important asset of all these advisors, and I think that's going to be prized going forward. So fully agree.
Joe, thanks very much for coming back in and talking through the two stocks, and we'll watch the IPO. As you say, it closes Friday, so there's still time for people to have a look at the prospectus and if they're interested, bid into it, and if not, it'll be up and running on the boards the end of this month in the secondary market.
Pleasure, Mark. Thanks very much for having me.